All right, as we see everybody filing in, I see you guys all getting cozy on your couches, prepared to, or sitting at your desk with a pencil, really ready to write down a lot of information today. I want to welcome you to our winter forum. Today, we're going to talk about things that are important, a bit more technical than normal. When we're together, we're talking more about you being on plan. But these are some of the basics, some of the things you're going on that are a bit more frequent. Things, if we've talked about them many times, to those who are new, pay attention. To those who have been with us a very long time, pay attention. And we will move on together. But I just want to say there's some great basics. I find that over time, I approach each thing with new eyes. You may hear something you've heard before, but see it in a completely different way. So with that, it's really a chance for us to talk about some of the different issues going on out there today. If you have some questions, you might also throw out there that are really tough. I'll direct them to other people. But if you've got some really easy, questions I've got answers to, I'll answer them right during the forum. At any rate, today, I wanted to let you know, let's see here, right now, I want to bring in Peter Nordenberg to begin his portion. But before we do that, I want to introduce you to our team. Here we all are. I think as you see, there's 14 of us here on screen. I can't see myself. There's 13 of us, I think, if you will, all waving, sitting, ready to answer any of your questions, attentive, looking at you. Hey, you guys, you probably should have dressed up. You probably should wear pants. And we can see that you're cooking in the background there. I just wanted to say a few things going on. Quite funny. At any rate, Peter, why don't you go ahead and take us away to begin our winter spectacular.
Thank you, Chris. Good morning, everyone. Thank you for joining us. And thank you for anyone who ends up watching this virtually later on. Again, I'm just going to go through a few things that are happening here at Gentian before we get to the meat of the presentation. Obviously, you got to see our phenomenal team here. Today's agenda, we will first touch on a Gentian update. We're going to go through questions that we're hearing from you, some timely topics. We will touch on financial planning. And then finally, a little teaser for the spring/early summer forum that we will have after Chris attends his Abundance 360 conference this spring. So we'll be talking a lot about technology and artificial intelligence in that section. Today, obviously, February 7th. It's always important to know what day it is. Tomorrow, though, on our team is Ryan's birthday. So if you have a chance to shoot him an email, wish him a happy birthday, I know he would appreciate that. Also in February, tends to be a month that we are very happy to add to our team, apparently. This year is actually Michael Birschbach's first anniversary with Gentian Financial. We're excited that he's hitting that 1-year mark. On top of Michael, February is the work anniversaries for Ashley, Lisa, Angie, Zach, and myself. So February is a very exciting month here at Gentian. Some other upcoming dates that we have. Next week, Monday, is session 2 of our book club. We had session 1 this past Monday. It was very good and informative. So hopefully you can join us if you're able to. Next week, Wednesday, February 14th, which is also Valentine's Day, is our February birthday lunch club. So hopefully if your birthday is in February, you're able to join us for that. On Monday, February 19th, for President's Day, our office as well as the markets will be closed. And then our next bi-weekly update is going to be on Wednesday, February 21st. Following that, session 3 and session 4 of the book clubs are Monday, February 26th and Monday, March 4th. So looking forward to seeing you on some of those events as well. As a reminder, if there are any events that you are looking to RSVP for, you can go directly to our website. On the events area, there will be an RSVP button for each of the upcoming events that will take you to either a Calendly or a Zoom link to get you registered, and then you'll be able to receive reminder emails for those as well. Some other exciting news that you probably saw in one of the bulletins that we sent out is Gentian was named as a best in-state wealth management team by Forbes once again in 2024. It is the second year of those rankings, and it's the second year the team has made it. So we're very excited about that, but also excited what that means for you as our clients. It's a tremendous effort that our team puts forth, but a testament to the trust and the trust that you put into us to work for you. So we appreciate everything that you guys do for us to allow us to be honored like this. Finally, at the end of the session and in our follow-up email, we will send out this QR code. If you take your smartphone and scan that, it will pop you up to a SurveyMonkey page where You can tell us what you liked about today, where we could improve, any other ideas or comments that you have. We always appreciate your feedback so that we can make these as valuable as possible. But that is all from me. I'm going to send it back to Chris so you can hear from him, Ken Flannery, Zach DeBoer, and Mike Mann today. Thanks, Chris. Chris, you are muted.
I just was practicing before I went live. So I wanted to just let you all know my going big today is adaptability. And I'm going to call it the portion that's called in sickness and in health. So I'll leave it at that. A lot of sickness has been going on through the house and different things. It's just great to be there for people and present for them. Even they say, hey, no, go, you're fine. I love just being there for them because it's encouraging. There's others as well. So mine is going to be presence. How about Ken?
Yes, good morning, everybody. Good to be here on the webinar with you as usual. My Go Big is a quick story. It's about hockey. My son plays, he's 10 years old, plays for sports, Ozaki Ice Dogs. And in the conference, in the playoffs to get to state, there was a team that actually cheated, and it was caught by the bodies that be. And so it was a great lesson to talk to our kids and the whole team and Parker, my son, about, the whole idea of, winners never cheat and really cheaters never win type of thing. So it was a great learning one. And hopefully it all gets worked out, and maybe it was by accident, but it was a great learning lesson right now.
Thank you, Ken, for sharing. How about Mike Mann?
Thanks, Chris. Grateful for a lot of different things, but mostly grateful for my family. I had a really good time this last weekend. We went out and got to spend the day together in celebration of my brother's birthday. So it's just wonderful being able to spend time with them, and the support and the relationship that we have. I'm truly ungrateful for it. It's great.
That's awesome. Thank you, Michael. How about Zach?
Yeah, thank you, Chris. As Peter mentioned, the work anniversaries. Hard to believe that it's been 6 years, and can honestly say my life took a completely different path 6 years ago. And the most amazing part is somehow I started here when I was 24, and sometimes Chris still refers to me as 24. So not sure how that quite works, but no. And also super grateful for the book club that we had on Monday. Just the opportunity. It was a great conversation with everyone that was on there, and just the wisdom that I received from you as clients, Chris, Ken, the team, is just incredibly humbling to receive at such a young age. So I'm extremely grateful for that.
And normally people will celebrate a book club with friends, their age, their experiences, their insights, and they're very common. What's nice about the book club is we start with people as young as 24, like Zach, and people as old as 84. Of Ken, I know he's 30. However, what's beautiful about that, we get to know people on a level that's completely non-financial, and people sharing, going through, even if you're just listening across there. It's been a wonderful, wonderful growth. We have probably 20, 25 people on there. We've done about 6 books so far. Please join in if you'd like to. It's a wonderful, wonderful offering that we have here. And I think the learning that we get from this one is how to know a person. And really, it's how to know a person deeply. And there's some really convicting, great items in there as well. Well, with that today, I know you're here for some finance. Normally, we're talking about other things. We do view you as a whole life, and whatever we can do to help you in many formats. When it comes to where will I live, when it comes to health, when it comes to diet, when it comes to mental health, you'll see some things along the way. We had a women's webinar recently, and in the women's webinar, we actually had 3 men join because they were so interested in travel, maybe 4. So it was kind of fun to see. They're seeing a lot of traction in some of those areas as well. So keep us posted with what's important to you. We'll continue to provide you with those resources as we see them, is because we have a wealth of knowledge by you and your family sharing what's worked well and what hasn't with you. So questions we're hearing from you. The kind of things that we're starting to hear from you is fairly normal. What's happening in the markets? We've seen the markets kind of up and down this year. We're seeing a lot of different semiconductor probably interest, and things move up nicely. We're seeing some of the stocks that got hammered in small caps. What's interesting is 2 years ago, what really, really happened is when the market corrected, there were some stocks that were some companies or stocks, I should say, that probably fell 80, 75%. These were the fastest growing stocks in the world. It was the single biggest corrections, I think, since 1972 in that category. So when things revert to the mean, people often think, oh my gosh, that stock is up so much. I'm not talking about the big ones, but some of the small ones you may not know as well. So when they go up 100% from being down 80%, you think, oh, that's impressive. Although to fully recover, they have to be up around 300 to 400% more. So you're finding some of the small cap opportunities out there are massive, as well as some of the emerging market opportunities. So we'll talk more about that as we go through, but what's happening with interest rates, they're all over. What should I do with my cash reserves? Been a big question over the last year or two, and we've done a lot with a lot of you as well. We also have a new update on that as we go through. We got yesterday. Should I be worried about the election? And the answer is no. That's all we're going to say about the election, because I know that you guys are all concerned. Hey, it's election year. Everybody tells me that, and everybody knows it. So it's not going to be a surprise. What planning opportunities are there? Why am I hearing so much about artificial intelligence? And that's a pretty interesting one. Artificial intelligence, who here's heard of it? Everybody raise your hand if you've heard of it. I can't see you guys, but I know you're all raising your hand. Thank you, by the way. But what's interesting about this is I got to ask you a question. Why did the AI go to school? Well, because it thought it could improve its learning algorithm by taking machine learning, literally. So for who know AI, that's really funny. The rest of you go, what the heck are you even talking about? We're going to bring in more about AI because it's becoming pervasive in people's lives on a day-to-day basis. We're talking about Jarvis co-pilots. We're talking about you having a personal assistant that's there all the time. There's a lot of things going on. Now, we brought this up to you about 6 or 7 years ago from our Abundance 360 program. And at the time, it was kind of a, oh, that's okay, interesting. What's it going to do? Now it's here. The beautiful thing about it, we've known about it for a long time. We've parsed it out. I would say that artificial intelligence will be one of the hottest topics that there are, and there's a lot of great things that can come from it. But at the same time, if there's great things that can come from it, there's also great, bad, rough things that can come from it. So there's opportunities in both directions, but it's probably the next internet type discovery that can move economics and productivity forward. As we move forward, I think that's what I really wanted to show. When it comes to what we're doing behind the scenes, who wants to go with the behind the scenes?
Chris, I'm happy to chat about that a little bit. So some of the things that we're always doing, and I could literally take this entire length of this forum and talk about how we are reviewing our portfolio holdings, what we're doing, the questions that we're asking our providers and their portfolio managers and anybody who we represent. I won't get any more into it than that. If you guys ever want to have a conversation about your specific strategy, please let us know. I'm always happy to jump on a Zoom call. Your advisor, if that isn't me, is always happy to jump on a Zoom call. Let's talk about it. We're always reviewing planning items. The planning landscape changes every single year. We get differences in what we can contribute, what we can't, and different tax laws. We got a big one coming up the end of 2025 with the sunsetting. So we're always reviewing these items and preparing you ahead of time before those actually happen. Looking at cash holding alternatives, these are what we said before is a big question that we're getting. What can we do for you with this extra amount of money so it sticks around, but maybe gets you a little bit of extra return? Always reading for perspective. I've picked up fiction lately to divert a little bit from what has been a lot of nonfiction in my life, mixing some of that in and pulling out all the good things. I know others on the team, we are all reading. We're all members of the book club right now when we can be, and it's really wonderful to bring that back to you. And always evaluating ways to improve our derivatibles. Peter coming into this year made a big comment that this is the year of doing. This is the year of taking some of that stuff and making sure that we put things into place and continuing to move forward. So a little behind the scenes peek, we are always looking at what different systems we can put to be more efficient and provide better service. Meeting with industry experts on any given Friday. I got 4 or 5 meetings. It's a task, and it's really enjoyable though, because it's some of the items that we can bring back to you and make sure that we're staying ahead of different things. And then always continuing our education. Peter and I were just down at EWAS, which is the Elite Wealth Advisor Symposium, learning all sorts of different things, bringing different perspectives, and just improving a little bit more of those for ourselves so that we can improve the service that we're providing to you. Chris, I can keep rolling with continuing education unless you want to bring somebody else back in for it.
No, that's all right. I'll run through a little bit as well. I don't want to put you out. I know Mike has a lot of energy. If you've ever talked to him about an idea, you'll get it. And that's awesome. He's on fire. So we appreciate Mike and what he's doing. And you really, if you do want to have a conversation about it, he is all about it. And he's very engaging. One thing I've been to Empowered Wealth yesterday, I spent 2 hours on a forum with one of the Carrie Oberbrunner, who's one of the smart contract person, who is showing you now how you can file a patent for $97. I can tell you more about it if you're interested in filing patents. I will give you the website if you'd like at some point in time, but it's really very incredible to see what's going on with that as well. We found a very smart person, found a wonderful way versus $20,000. Sorry for any attorneys who file those, versus $97 to at least file a smart contract and begin the patent process, which is very cool. I also recently was very fortunate to sit down with somebody, RJ Shook. You've heard about the Forbes ratings and others. RJ is actually the company that does the data behind those ratings. So fortunately, I got to have a private lunch with him and 4 other advisors before I did a big symposium. We're blessed to get in there, and thank you for your confidence, because you're the reason we do get into this. And it was wonderful to learn about this. And he is very much about the individual advisors and what got them into it. And I am asking more questions about how do these, quote, wonderful advisors make a difference in the lives of their clients. That's what he says he measures most. So as we go through, I wanted to learn what that was, just for ideas and how we continue to impact your life in a positive way, but not be too intrusive. So a lot of things we offer here. We've got a very wide offering, and I want to make sure that you know that it's there. You don't have to participate in everything, but sometimes I call it a fire pit moment or a fire pit item. We have a fire pit out back, and people look at it every time they walk in or even that drive by our office. And I call it a fire pit moment because it's something here that gets used every single day, but nobody sits at it. You know what I mean? It's there for you. You know it. I want to make sure you understand that. We'd love you to use it if you'd like, but I wanted to bring that up to you as well. So a lot of wonderful opportunities. And RJ was very, very sharing about it. He actually was kind of surprised by the questions I had and was really directed at how can we do better for you. So I know you know that. You've heard enough of that. But let's get into some of the things we're hearing from you and more of that goes with the market. So the first thing we look at is what's happening in the markets. And I think as we take a look at maybe 2 of the things for 2024, you know, that we have the election coming up, and that is a big portion of everybody's worries. Somebody said we have 2 of the oldest candidates. They made some good jokes about older candidates, and I don't want to repeat them, but you'll hear plenty of those as you go along as well. And by the way, if you think the words they're talking about are bad, go back to Thomas Jefferson with John Adams debate. I can't even tell you on this broadcast what they would say about each other in publications and in public. You think today is bad? It's tame compared to what the forefathers would say about each other. So take a look at that. Politics is known. There's some great slides we have coming up talking about those, but the markets have been a bit choppy here. We've had some great earnings reports. We've had the economy a little bit better than expected at 3.3%. Nobody expected it to be so good. There's a few things going on that are like that. But what I'd like to do here is kind of look at a 2023 in review, and I'm going to run that over to Zach, if that's all right.
Yeah, thank you, Chris. We'll go through this in a lot more detail when we go through rebalancing, but just kind of wanted to show the different asset classes and the difference between 2022 and 2023. And really, a lot of the slides that we're going to show, they're very interesting to us. We pulled a lot of different things out of it, but a lot of them are just validation of our timeless principles, which is really asset allocation and diversification, which this helps show here. The benefits of rebalancing, which we'll talk about a little later when we bring in financial planning. There's no future facts. Corrections are normal and necessary, and they create unbelievable opportunity for us, both planning and also for the market growth long term. If we take a look at this slide here as well, this is kind of just the faith, patience, and discipline that goes along with it. So if we look at 2022, you can see some pretty steep corrections in different asset classes. One of them is US large cap growth, global developing equity. We have Europe, we have US small cap around 20%, temporary correction in 2022. We have emerging markets temporarily down 20%. We have 10-year treasury with the increase of interest rates. Bond prices dramatically fell very quickly, and also difficulties in China as well during that time. And then represented by the red bar, we look at 2023 returns. And you could take pretty much every single year looking back at it, and we'll go through that more in rebalancing. But some of the worst performers became the best performers in 2023. What often happens with investors is a mistake they make. They look at 2022, oh, it's not a good time to be in large cap. We got to rotate out of that. We got to get into something else. Look how good energy's doing. We got to shift money over to that. That did really well this year. When they did that, look what happens. They missed out on all the upside coming back the other way. And the beautiful side of rebalancing is just being able to trim back or add more to certain asset classes during those years. One really interesting thing, if we move on to the next slide, is just how much of that return is due to 7 companies. We've heard of the Magnificent Seven, been in the news a lot. At one point last year in 2023, 92% of the S&P 500's return was from those 7 companies. So I remember in I believe it was 2017 when Apple first crossed the mark, and then quickly after Microsoft of the $1 trillion mark, and it was this unbelievable thing. Now there's 5 companies worth over $1 trillion, some getting close to 3 trillion. There's another one that just went up quite a bit over the last few days that's right on the edge of turning $1 trillion as well. So just really fascinating to see. Again, what is a mistake that a lot of people make? Oh, the Magnificent Seven is where you really want to be. Those are going to continue to reshape the future. What happens if they don't, right? So with that, I'll pass it over to Mike as just kind of some top global risks to look at in 2024 here as well.
Thanks, Zach. So this is a very interesting chart. Basically, what this is that the World Economic Forum surveyed almost 1,500 leaders on the top global risks and their potential scale of impact. So really, this is the agreement onto what could be a huge risk going into the next year. And there's a ton of things on here. We never know what truly will be. And 66% is very far away from being sure. So when we look at these as a percentage standpoint, please don't put too much into the fact of how big that bar is at the top, because it's still a long ways away from 100. Nobody really knows. The one that I really want to focus on is the third one down, and that's societal and or political polarization. And I want to make sure that everybody understands that the risk isn't the fact that there's an election. It's not the fact that somebody different is going to be in, or could become that the new president, or there could be a changing of the guard in that regard. But it's truly the fact of misinformation and political polarization. That is the risk around the election. And obviously those things come up more and more and more because of the fact that it's occurring. Not the risk that somebody different gets elected. It's truly just all of the stuff that's floating around and all of the fear that that creates onto what a change could mean, even though that could just be smoke. And that is necessarily the case in how we're looking at it, because the election itself is not the risk. It's all that information around it. So I just wanted to point that slide out a little bit. If we go to the next one here, this feeds right into what is the annual end of the world. And so any one of these individual events are the ever inevitable unforeseen events. Now, when these things occur, we see fear in the market itself, and that's represented by the red dots on the bottom of this chart here. That is the intra-year decline from whatever that high was previously down to that point. So in any individual year, and my favorite is to point out 2020, which is 16% up. It's the fourth bar to the left. Thank you, Peter. It's 16% up. And we saw that being at one point during the course of that year actually being down 34%. That occurred through March, or February through March of that year. When you ask somebody how they felt the stock market did in 2020, nobody thinks that if you would have started at the beginning, ended at 16%, when you look at this chart, it's almost like COVID never even existed. So taking that all into account, corrections will happen. They're normal, and they'll continue to happen going forward. We have to stay invested, because that's how you truly capture the long-term rate of return. Because if you get out when you're down 34%, you sacrifice all that upside on the recovery.
What's really interesting on those slides, Mike, not this one, but the one before too, is how little the impact of the global World Economic Forum saw on things like tech bubble burst, 4% risk, right? Accidental or rates of like biological agents. These are things in the past that, had they come out, would be very big. But today we're looking at extreme weather, which is an amazing one. You're seeing that in California and others. It's amazing to see what happens over time when they change as well. So thank you. I just wanted to add some perspective there. We've seen many of these as top risks before, but they subside. When you look at personal risk, it's number one for people: fear of death, fear of social rejection or embarrassment, fear of spiders. That's number 3 for personal fears, by the way. Fear of failure and fear of heights. Kind of funny when you look at that. That's personal. So we can transfer those fears to other things as well. But fears drive a lot of people. I just wanted to make sure we talked a little bit about that as well.
It's hard to believe there's not snakes in there, Chris. I don't know how that list is that accurate. So
if it was about Ken, that might be the case.
Yes, very fearful of snakes. Number 1 for me.
Exactly.
Bring on the heights, bring on everything else, but the snakes, no thank you.
Anyway, we were talking about technology, and I was going to ask a question here, but I asked Ken, so why is the computer cold? He said, well, why? Because it left its windows open. Anyway, so with that, we can move on. I just had to throw a joke in.
I love it, Chris. That's fantastic. So the next one we're going to talk about is market corrections here, and the slide's going to come up. What I want you to do is I want you to close your eyes while I read the first 4 or 5 bullet points here. Close your eyes. You're at home on your couch. Close your eyes right now. They are swift and visceral. They come without warning. Their length of stay is unknown. They are not pleasant when they are around. Now, open your eyes. Are we talking about my in-laws, or are we talking about the markets? I'm not quite sure on that one, but I think it is the markets, and they are very, these market corrections, we've been waiting, or I would say the economists have been talking about a market correction for a very long time, and we've seen a couple of them. 2022, we'll talk about that here in a second. We've been waiting for this for a long time, and it's been 3 or 4 or 5 years. And yes, we've seen a couple of them, right? But we haven't seen that big one that I think that most people are expecting. And if the markets stay down for 2 or 3 years, we haven't seen that in a little while. So these market corrections are very important. If we learn how to tolerate them, which is a very difficult thing to do, but if we kind of build that into our education about what the markets are, if we can tolerate them, if we can embrace them, if we can look at for the opportunities when these happen, this is when your retirement becomes even more secure at that point in time. That when we talk about market corrections, staying to the plan becomes even more important. We talk about your plan. This is the time when we see these market corrections to really stick to the plan. So in a time of uncertainty and market corrections like this, making big changes, if your scenario hasn't changed too much, then just because of something that's happening in the markets, that shouldn't change our plan going forward. So that's what I have to say on market corrections on this slide. If we go to the next one, you'll see.
Well, also, to reiterate what you just said too, if you looked at the recent piece that we sent to all of you about the beginning of the year letter, it's going to reiterate those same kind of topics. It may seem like fundamentals, you've heard them before, but unless anything has changed in a major way, your plan is prepared for it. Even if things have changed in a major way, your plan is prepared for it. So we prepare for the inevitable, we prepare for the unknown, and then we just hope it doesn't happen. But being prepared is the key. So I just wanted to reiterate something you said. That's super important. Thanks, Ken.
Yeah, appreciate that, Chris. Thank you very much. And the one you're looking at here is the corrections. We do talk about them in the meetings. When the markets are going up, it's fun. And when the markets are going down, it's also fun for us to bring up planning ideas for you. We'll talk about some of those opportunities that we see when we do go through a market correction, which tend to be temporary, as a lot of you know. So, the last one that we've seen here on the slides here in 2020, we can actually make this more relevant. They will go back to 2022. 2022 was a time where the markets went down about 19 to 20%. And that actually lasted for 22 months. If you think about this, 2022, the whole year, pretty much down. 2023, last year, it was kind of flat for the whole year until November and December. So if you take 12 months of 2022, 10 months of 2023, now we have 22 months basically of what we call a market correction, if you will. So they do occur. They are going to happen. If you've been retired with us for 20 to 25 years, you've seen 3 or 4, maybe even 5 major market corrections. And you know that they're temporary because of your experience of going through those. And so for our new retirees, that's something that we have to go through, but we'll be here every step of the way. When it doesn't feel right, when you leave your great paying job, and all of a sudden you see your wealth going down temporarily, and it seems to be vanishing temporarily, that's when it matters. That's when we step in to make sure that we stay to plan. We make sure we get through that, because if we can get through that together, then the next upturn is going to be very, very sweet. And that actually helps ensure your successful retirement as we go through those pieces there.
Yep. There's some words we can't say, which are the word insure. No, I'm just joking. I'm messing with you.
Let's talk about insurance.
No, exactly. I know. I understand. But the interesting thing about what Kenny just said too, I want to make sure you know that we know as well. It is not easy. With all this stuff going on with politics, your personal opinions, your friends, your relatives, maybe your spouse, all bringing up things, and maybe they're a bit of a diminisher. Maybe they tend to blow things up quite a bit. It's hard to remain calm and think that you should do nothing. We have probably between 30 to 50 trades going on every day amongst your portfolio, amongst the different managers. There's a lot of activity. We shield you from it because it's actually psychologically best if you don't know the moving parts every single day, because you'll make poor decisions. This is data that's won Nobel Prizes. We want to make sure you know that. This is based off of massive science about us as humans. We have fallacies. We have biases. We do things that are kind of messed up. We want to make sure we help you prevent that and you stay on plan, because many of you have become phenomenal advisors if you're newer, or phenomenal clients. If you're newer, we want to give you perspective on this. If you've heard it before, thank you for being patient and hearing it again. But I just wanted to put that out there, Ken. You made a great point. I just wanted to reiterate that.
Yeah, thank you, Chris. We'll run into the next slide here as well. And to Chris's point and the global risk, if anyone gets anxious with that or finds themselves watching the news a lot and looking towards the next big risk and being very anxious about it, there's a very good book out that came out this year by Morgan Housel called Same as Ever. A couple of people that I know read that, said that after they read it, they completely stopped watching the news. They stopped even worrying about the markets, because really the whole premise is if humans are involved, there's nothing new. Right. And the risks that are the biggest ones to us are the ones that we don't see coming. We didn't see COVID coming in January of 2020, didn't see Russia-Ukraine invasion in 2022, all these different things as well. So if you ever feel anxious with that, it's a phenomenal resource and book for you there as well.
But don't read it yet, because it could be the subject of our next book club.
Oops.
So that
But,
was something you mentioned in the last one, but apparently read it now to prepare for months. And I'm just joking ahead. That's all. It's a great book. I agree with you, Zach. Tremendous.
Yeah, appreciate it. This one we'll roll right through, and this one is actually one of my favorite charts that we show, and we've gone through it before, but really just like Chris talked about and Ken and Mike as well, is the fundamental. The Vince Lombardi, this is a football, and it's important to go through each and every time. And as a reminder, if we started on the left side of this chart and asked you the question, in the short term, where is the biggest risk? The green bar represents stocks, blue bar represents bonds, and the gray bar represents a 50-50 mix of between the two. On the short term, it's obvious on this one that stocks carry the most amount of risk, the biggest upside, the biggest downside on a 1-year basis as well. As we shift from rolling 1-year periods to rolling 5-year periods to 10-year periods, it evens out a little bit more. This is rolling periods since 1950, but where this becomes the most beneficial to look at is looking at rolling 20-year periods. We ask the question of, again, where is the biggest risk now? And if we take a look at that, the worst 20-year rolling year period for great companies and stocks is 6%. The worst 20-year rolling period for bonds is 1%. So bonds carry a 6 times greater risk than stocks over a longer term period. That's why as you head into retirement, it isn't just shifting everything towards cash. We still have a long-term view with it, and we need something to continually beat inflation over time, and having a great mix between the two is extremely beneficial. So weighing the short-term risk, 1-year time frame, we look at that too. We heard this to start 2024 was, it's going to be a tough year for stocks. So we heard for 2023 as well, and 2021 and 2020 and 20. Every single year it's kind of a reset. And if we looked at rolling 1-year periods on positive returns, 75% of the time since 1950, it's actually positive. So by coming in with that perspective, we're already speculating against history being in our favor anyway. So just extremely great to look at. Love this one. And with that, Chris, kind of share some of your perspective with small caps coming up in the next slide here too.
I talked about this a touch earlier. It's a very interesting idea, and that is historically small caps lead us out of a bear market. And this slide is actually showing us on a consistent basis. There's some data behind this that we don't necessarily see, but normally small caps will lead us tremendously out of it. Now, small caps versus the S&P, this is normal. It's 130%, if you will, when a normal market recovers. So far, though, this has not occurred. So this that you have seen is the blue line is small caps. It normally leads us out. Small caps are still meandering pretty close to some of their lows. They've come up a bit last year. But what we're finding is something called mean reversion. So we're offering a perspective of when things are heavily undervalued, much like emerging markets are as well, just to come back to where they normally are, there'll be a significant return. Now, you'd expected that to happen a year before, the year before, who knows exactly when. I talked to Dr. Eugene Fama, he's a Nobel Prize winner, and he actually said that it could be up to 12 years that this happens. He actually said 1,200 years and made me go, oh my gosh, then he laughed and said it was 12 years. But what's interesting about this, small cap has been underperforming, if you will, but it is a tremendous value according to its trend line. Mean reversion says it reverts back up to its trend line. So looking at this, it's a really interesting point. Just taking a look at, we've got categories like this when we rebalance that we're buying a lot of that would very well may be the next great upturn. So this is where Zach will talk a bit about more of that on a go forward basis, but thank you for allowing me to hop in on the small cap perspective idea as well. So next slide, before we go to the next slide here, actually, even you can go to it, Peter, but here, I want to do something. I want to make this interactive. We've got a lot of stuff that we're talking about here, and it's stuff that we've decided. It's things you brought up, but stuff we've decided. I'd like you to maybe stand up off your couch, if you're on the couch or sitting in front of your computer here, and I'd like this to become participatory. I think it's a real word, but if not, I made it up. Participatory is this. I want you to go in the Q&A, and I want you to give us what your biggest concerns are, what you'd most like to know about. You can do it anonymous. You can put them out there. I can't promise we'll answer everyone on here because some of them we can't. They won't allow us to compliance-wise. But I would like you to put them in there. I'd like us to be able to move some of this in the direction of what's important to you or some of the biggest things you're curious about or the things that are facing you right now as well. So with that, I want to make it a touch interactive. If we get 15 or 20 or 30, we'll probably answer a few here. If we get one or two, we will also probably just answer those unless they're really tough. So we'll go through. So I'm gonna cue the questions up. Why don't we go through the presentation a bit more? And as we get to the next section, I'm gonna go ahead and then we'll stop on the cues, the questions. So why don't we go next to the next slide, looking at what's happening with interest rates, Mike, man.
All right. Well, you guys all know I love talking about interest rates. And if there's anything I love talking more about interest rates, it's the Federal Reserve. So anyways, what we're looking at right now is that what is truly happening with interest rates. And I heard a really good comment from one of our partners recently saying that, this isn't higher for longer, this is normal for longer. And I do just want to remind everyone that what occurred over the last 10 years was truly an anomaly in comparison to history of where interest rates really were. And because of that, we are now back to a point that all of a sudden the United States, and I'm always surprised at how surprised others are at how resilient our economy is, seems to be able to cope with a higher interest rate environment, and things are seeming to be a little bit better than what they were before. That being said, the Federal Reserve has come out and stated that a couple different things of what they're going to be doing, and really they're looking for opportunities to potentially lower interest rates in the future. What's that opportunity for them? Well, that's up to everybody else's interpretation. Peter, if you wouldn't mind bringing up the slide, interest rates here, you can see that every major bank kind of has their own idea of how expected rate cuts are going to be. And I want to define rate cut real quick for everybody. So right now, interest rates are about 5.25, 5.5%. A rate cut is 0.25% downward. And that's just them making that cut. So 8 of them would then be, is that 2% in rate cuts? That would be, yes, math, sorry. Anyways, so if they came down 2%, that would bring it to be about 3.25, 3.5. Is that realistic? That seems a little, it seems like a lot. And what we're really hearing is maybe 3 this year could make a lot of sense. We'll see what ends up happening. But what the Federal Reserve has said is that even though in lieu of even though the labor market, if it continues to be strong, they won't cut rates, which is unique. And so we saw something very interesting happen. We had a very good jobs report recently. And what ended up happening? The market went up. Well, who would have thought? The last 2 years, whenever we had a good jobs report, the market would truly go down because it meant that the Fed could raise rates higher. But because they came out to say this, things are starting to move in a way that is more normally predictable. Are we going to predict it? We are absolutely not, because who's to say when things could turn in the other direction? But what we're seeing with interest rates in general is a steadier, longer term rate. We could see it come down a little bit this year. We'll get more clarity. Right now, it looks like the market is pricing in potentially a 25% chance of a rate cut coming up in March 20th. And then further along, that percentage gets higher. So that stuff's interesting. If you want to talk those numbers, you know where to find me. But Peter, if you wouldn't mind just bumping into the other slides here, we just got some other good data about interest rates in general. These are the values of cuts from different institutions that people expect, what we hear from others, and what typically happens. These are predictions. These are assumptions. We never know truly what's going to occur, and we're not going to hold them to their word to do so. But we will see what ends up happening this year. What we've heard is 3 cuts is kind of the general consensus. Peter, if you bump to the next one, we got past interest rate cut cycles. These are all just going to be, these are more trivial numbers when it comes to when rates are going to cut, because there's events that occur that causes the Federal Reserve to change the rate itself. And that's typically a recession. The economy's strong right now. Can we compare it to what the cycle was in the past? Maybe. These are sort of different times, so we'll see what happens going forward.
Nice. Appreciate that, Mike.
Absolutely.
So the next one I think we have here is looking at what should I do with my cash reserves, which is quite funny because one of our questions was about cash reserves. Remember, those who'd like to put questions into the question and answer, the Q&A, it's one of the questions we actually had. And there's a lot of issues going on right now with cash and cash reserves. Banks are still offering, right now there's a lawsuit. And let me give you this with, I think it's against Charles Schwab or Fidelity about their IRA money market rates for cash that was sitting in them was 500% lower than the mean. I don't know quite what that means, but there's actually an attorney in a class action suit going after them for that. And that's driven by the attorney trying to make money more so than clients going after that company. But interestingly, there's a lot of issues with cash now, and cash is very high. You're going to find if you go out very long right now, you're going to find rates are actually lower. It's kind of an interesting point. Now, I know we're going to cover cash here just on this very next one. I think, Mike, you wanted to touch base on a few of the cash ideas. Is that correct?
Yeah, I can jump into some cash ideas here and what we're looking at. And really what this means is kind of what we talked about before with what happens with interest rates. One thing that I want to relate that back to is what does that actually mean for the individual? And truly, if rates are going to come down, that means better opportunities to finance. If rates normalize, we can be expecting rates to be similar to what they are, and that will eventually be a derivative, or prices will be a derivative of what that is. So interesting to see how that's going to shake out going forward. Things that we can do right now with cash to get a little extra return. This chart shows some of the averages starting in the 2020s. You can see that the average of CDs is very low, and this is to the end of last year. Last year being 2022, because I'm not living in 2024 yet, apparently. But this shows that the average rate of a CD right now you can get, and we're seeing somewhere around 5% or so on 6-month CDs. It's incredibly interesting to see how fast that's come up. So that's an opportunity to lock in an interest rate. You do have to pay back some of that interest if you need that money in a short term. Something to just consider. We really like the opportunity that exists within high yield money market type accounts, high yield savings, and then even bonds these days. With a normalized interest rate, what happened in 2022 with bonds falling so dramatically was because interest rates were going up so quickly. As we spoke about before, when interest rate rises, prices of bonds that have already been issued fall because their interest that they're paying to that who holds it cannot keep up with a new issued bond. So those then start trading at a discount, pushing down the prices of bonds. When interest rates normalize, you start to see bonds returning closer to what their yield actually is. So if we bounce to the next slide here on cash alternatives themselves, we talked a little bit about some of these items: high yield savings account, high yield money markets, Series I savings bonds. These are the inflation adjusted bonds. Now, something interesting has occurred with these. These became very popular when inflation was running rampant. You're able to get 9% divided by 2 for a 6-month period, and then be able to continue onward. And we actually see that variable rate due to inflation come down significantly in that regard. Currently, that variable rate is right at, we're seeing it being at 2.64 or 1.97%. That is the variable rate of inflation currently. But what you can do with a Series I savings bond or an I bond in general is that right now it's paying a fixed rate. So there's two pieces to an I bond. Previously, the fixed rate was 0%, which is a very high variable rate based on inflation. Right now, if you buy an I bond, you can actually get 1.3% as a fixed rate. And then whatever inflation does, it adds on top of that. So there are opportunities in I bonds. The return itself is, from an annual standpoint, is 5.27%. You can do a little bit better right now in a money market account. It all depends on your particular scenario and the different opportunities that exist. So if you have more questions regarding that, as always, please let us know, and we can talk more about some of these different concepts.
Awesome. Thank you, Mike. And one of the things too I found is, and this is just an idea of cash. This is cash alternatives, but cash itself, one of the big questions we've gotten over time is, we're moving all the digital. Is cash going to go away? Well, maybe pennies will. that's a lot of money that they charge to print pennies, but they're not used that much anymore. Maybe it's going to be down to nickels. But what's interesting is the cash outlook. I looked up this, and for 2024, it's actually multifaceted, with trends kind of moving around things such as cashless transactions driven by the adoption of mobile wallets. So people can walk around now with their phone and you can pay almost anything anywhere. Matter of fact, sometimes I forget my wallet because everywhere I go, there's cash. And when you you can use the mobile payment, even on vending machines. I was just in Minneapolis and I could buy a soda for $4 with my, they could, extort the money from me through my phone rather than just me putting $4 in as well. But what's interesting, due to the unbanked mass, meaning most of America is not heavily banked, they operate on a cash basis. Cash will be continually important for most of our lives or all of our lives. So for those of you who are cash fans who take money out of the ATMs and others and use it from the bank, it'll still be around. I think that worry that within the next few years it's going to go away completely is not founded. I just wanted to bring that up because that was some perspective of questions we've had about cash as well that weren't listed here. What I'd like to do though here is, before we go forward, looking at election years, that's coming up. And as we go through here, there was a couple of questions I can kind of answer in order as we go as well. One, the first question that I had as we go up here was World War III. What about World War III? And that's a lot of the politics going on, of course, with what's happening in the Middle East, what's happening, with all the issues in the Red Sea. If you can take anywhere in Europe all the way down to Israel, there's issues going on everywhere, and it's a very unsettled area. If you read the Bible, it actually says the Middle East will probably never be settled. So it's not wildly surprising if you're looking at big, long historical context. But when you're looking at, potential for World War III, there's a possibility. Obviously, where will it be fought? Will it be fought? Will it be fought by us? That's a concern that's always out there. Our goal is to minimize that. I know through the military, that's their answer, to minimize that idea and just keep, wars territorial. But in a too big World War III, I don't think anyone wins. So I think that's a question that maybe doesn't have an answer. Anybody can say, oh, this will happen. But we've been through World War I and II. And let me ask a question. Were those temporary or were those permanent declines? You might look at that as the decline in the market was temporary. The decline maybe in living in some of the, the countries, Germany, it took a while to rebuild. A lot of it, France, England, but they did rebuild. And you'll see that. So you'll find that these highs and lows of wars aren't very, it's not fun to see. Obviously, we pray for all those who are out there and those who are innocent in the midst of them. But I think it was a great question people are asking. I did want to address that one as well. There's, I think, four more, and we're going to talk a bit about inflation coming up. That's one of them. We've got a question of when do you finance and when do you pay cash? That's an interesting one. Ken talks a lot about that. I might bring him on for a quick answer for that one, but just my 2 cents before even Ken jumps on is we're at a level here where financing probably above 6 or 7%. If you're looking at it as a finance number, if we get a return of 7 to 8% in our portfolio and we're borrowing money at 2 or 3, that's a given. You finance, right? But if all of a sudden we're borrowing at 10 or 11 and we're getting 7 or 8% on our portfolio, we might start to look at ideas like paying down. So it's going to be very personal. But that's just something I wanted to bring up from my side. Ken, is there any other insight you want to add to that?
Yeah, I think it is personal, Chris. I think it's a good point you make there about like interest rates and where they're at. And when it comes to like vehicles, that's a kind of common one that we hear, how should we pay for a vehicle? We need a new one. We have 40,000 on our 2015. That's what we do here once in a while too for me guys. But if we need a new vehicle, how do we do it? And some vehicle manufacturers do offer decent interest rates as far as financing goes. Sometimes you'll find like a new vehicle at 3.99 or 4% or 4.5. That's actually pretty good. And we like the idea of maybe financing that because of where the interest rate would be. Now, when you take a look at home equity lines of credit, that used to be 3s and 4s, where we were taking money out of the equity of our home basically and being charged 3 or 4% to make that renovation that we wanted to, or the new addition on the Four Seasons room or something like that. That made a lot of sense at that point in time to use the home equity line of credit when it was 3 and 4 versus using our investments that we're doing, like Chris was saying, historically 7 and 8. So again, that whole thing is flipped around. So now we have to kind of say, do we really need to make the remodel? Do we want to make the remodel? How much are we taking out of our investments to begin with for income in retirement? If we're at that 1 or 2% rates for a distribution, there's some wiggle room there to get up that 4% that we like to talk about from an annual distribution rate out of your investments. If we're already hitting 4, 4.5, 5 of a distribution rate out of your investments, and you want to take more out of it, That's going to be a piece that we need to talk through to make sure that the longevity of your plan stays intact, rather than trying to fix something around the house. I know you want to, we live there, we want it to be nice. So it's this balancing act that we have to go through. And again, it is individualized, and we certainly would love to have the conversation with you if that is your scenario.
Yeah, thank you, Kim. That's awesome. So one other question came in is about inflation. I think we touched on inflation before, but inflation is the biggest risk we see. What is the projection? So the projection in Turkey is year-over-year inflation is 65%. Oh, I'm sorry. It was a question about U.S. because it wasn't specified here. So I call that a can-win question, but it's true. Turkey's prime rate was 25%. We visited there earlier this year, my wife and I, last year, I should say, and the prime rate was 25%. Inflation year over year is 65%. You look at that, that's absolutely amazing. So interest rates there, buy a Turkish bond, maybe get 20, 25%, but then repatriate it into our money and maybe you'll lose, who knows? It's a very big risk. But there's inflation going on around the world and in the Middle East, which is pretty amazing. Here, looking at probably 2.9% is what we saw if you looked at year-over-year inflation, and it was 0.2 in the month of December. The inflationary items that could occur are going to be the Red Sea issues, shipping, some of the things that one of the clients was mentioning about WW3, just the unrest in the Middle East, are some of the issues that we need to take forward. So there's projections, but reality is always going to be slightly different. The Fed's goal is to keep it de minimis at around 2. So whatever they can do to do that is important. We had massive wage inflation as well, especially for those in the bottom and the least wealthy, the lowest earners actually had the biggest increase in their net worth or their income during this last recession. So looking at that, it's very interesting to see. And that's one of the questions we have. Can the wealth disparity continue to grow? What will be the effect or the society and economy? So this is called the can't win question. So there's really no answer to this that I can give that helps anybody tremendously. But what I want to do is say that that does exist. And I guess as in people who invest, who are getting 7 to 10% on their savings or more, versus most of America in the world that doesn't invest, I think that there's almost no question that the wealth inequality will continue to grow. Can the world help that? I think many of the programs attempt to do it. I guess what's remained to be seen oftentimes is, do the programs work in redistributing wealth in a reasonable way, in a benign fashion, or is creating more jobs for people with higher income a way that, quote, the rich can give back? There's a lot of questions to go with it. I've seen a lot. You can look on chat.gpt for a bunch of arguments either way, but it's a very interesting question. It requires more depth, if you will, than this. I wanted to go into one thing, though. So looking at this, and I asked this question to chat.gpt, going forward back to the presentation, we're going to take a look at, should I be worried about the election? And you can be worried about anything you'd like to be. I'd like to reduce that if it's possible. I think here's some quotes that go on about that. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 to Las Vegas. That's what they were talking about with when it comes to politics and all the ideas going on there.
That is not an investment recommendation, by the way. I just want to put that out there. Don't take your money to Vegas to try to get rich.
Thank you. I did say if you want excitement, so that's definitely not investing. That is totally with it. I appreciate you. Another one as well. Political events can trigger market reactions, but the economic fundamentals drive long-term trends. So that was a good one as well. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. That's Benjamin Graham. That is the precursor to Warren Buffett. It's his teacher. Do not take investment advice from political forecasts. That is from Burton Malkiel. He wrote a book called A Random Walk Down Wall Street. For Peter Lynch, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So this is a great one. Warren Buffett said, the stock market is designed to transfer money from the active to the patient. So when it comes to political times, this is a great time for us to be the patient ones who have value transferred to us as others freak out based upon a political candidate. Now, I'd like to hop back into the presentation because it's going to show you one more thing. And I think weighing your investment decisions through the lens of politics has been quite detrimental. So let's go to the next slide if we may here. And taking a look at this slide, this is basically giving us 2 different methods. It is saying one is only investing during a Republican presidential period of time. 2 is investing only during a Democratic period of time. Those are the red and the blue lines at the bottom. Look over history, though, since 1949, if you stayed fully invested during both. There is zero question what is best. And you're going to find that many times political candidates will take credit for things that occurred during their administration. But I'm fairly certain that Bill Gates, I'm fairly certain Elon Musk, I'm fairly certain most of these people who invented a lot of the things that we use today and the technologies we use did not care who was president. I've been fortunate enough to ask a few of the people that question when we've been at our technology forum at Abundance 360, and they look at me as if why would we care? We're trying to make society better. So it was interesting. So taking a look at this, if you ever wanted to know and you have a bias towards something, I would say the bias should be toward remaining neutral, especially when it comes to your investments. That's our advice on this, based on experience and also based on data. But any questions on that? Good, awesome. That means you've all got it. I like asking questions on Zoom because nobody has the questions other than the ones we have on the screen. Let's go to the next one as well. The S&P during election years. It's going to reiterate the same topic. So as you go through, this is going to be hard to see. We've got Biden, Trump, you've got, Obama, you've got Bush, you've got Clinton. As you go back, each one of them has had a wonderful time. Matter of fact, one of the worst returns on there happened during, during a time when we had a massive recession. It really didn't matter who president was, but whoever was there was going to get the moniker for it and say, oh, it's because of them. It's not true. As you go through, we have an economic cycle that is independent of a president. An economic cycle, we are first an economic engine loosely knit by politics. So I want to make sure that you guys understand that. So as we run through some of this data, why do we remain as we do? We've studied it, we've lived it, and you can have a very strong opinion one way or other on your politics. We're completely neutral to that, but we are here to help you with your plan. I've seen people make massive mistakes on politics, and the minimum in ours is well into the double digits for the minimum loss because they made that decision. They've all regretted it, but I want to tell you, people have made it. So anyway, I wanted to make sure that comes up because you're going to see a lot more of this. It's only going to become more amplified as we move further on. With that, I want to hop off the politics and hop off the soapbox of politics and hop into financial planning. Let's take a look at the financial planning items that we want to go through here and what's happening that we should be looking at when it comes to opportunities in planning. So 2024 is going to be tax planning. Who wants to take a stab at looking at what's going on with taxes? Ken, you're kind of a resident tax expert when it comes to Ed Slot. Anything that you see we should be taking a look at 2024?
Yeah, good point, Chris. I do like talking about taxes. I think it's not necessarily what you make, it's what we keep. And we love that piece here, and we try to keep as much money in your pocket as possible. And we do that through the work of tax ideas for you and making sure that they make sense by using a tax advisor to really implement some of those ideas. So what we like there is the tax planning. So right now, taxes are here, documents are coming out. You'll probably have already received your 1099-R, which is your retirement account. So if you have an IRA, you've took some money out of there. If you've done a conversion, you'll see those. Those are typically available by the end of January, early February. Here we are. So most of you have those. Now, if you have a personal investment account, and some of these are in the form of a trust, some of these are in the form of a TOD, some of these are in the form of joints with rights of survivorship. Those are some names that you may see on your statements. Those are personal investment accounts that you have that are not under the IRA or 401k or tax deferred umbrella. Those documents will be available by March 15th. So that's the latest they come out, expected by March 15th. Sometimes they come out earlier, but expect March 15th. So if you're preparing for your taxes and you want to make an appointment with your tax preparer, I would say that make an appointment after March 15th if you do have a personal investment account that you're expecting a tax document from. So just want to put that piece out there for you guys there. If you have questions on that, we're here to help you out with that. Some of you get them electronically, and sometimes we miss them because it's electronic. Sometimes it goes to spam, or we just miss it. Some of you get those by paper as well. So again, if you have questions about tax documents, we're here to help you. But again, expect March 15th. When we take a look at tax planning in general, I'm actually going to pull up a different slide here. And this is something where you're going to probably look at this and be like, oh, that's interesting. But what do we do with the information? So it's one thing to have the information, but it's another thing to do, like, what do we do with it? And so when you look at what's new in 2024, we've seen, you're looking at tax brackets right now. So not something you probably look at every single day, something we do. We enjoy this piece because again, it helps you for planning and really trying to put more money in your pocket, your family's pocket, and that sort of thing. So when you look at this, what's different from 2023 to 2024? You can see on top here, you'll notice the brackets from 2023 on the left, 2024 on the right, and you'll notice that on the right, they've expanded. So for example, in the 10% bracket, you'll notice that married filing jointly, it went from 0 to 22,000 up to 0 to 23,000. But it gets more dramatic as we go down the line for 12% bracket, 22, 24, 32, so on and so forth. Will we do this information? So if we're talking about Roth conversion planning, we'll talk to you about that. If you've done those, we have a little bit bigger window now to take advantage of that. Or the other way to look at this is we have a little bigger of a window to have more income to stay in a lower bracket, if you will, rather than jumping up and having that incremental increase on the next bracket, say the 22 or the 24%. So there's information we have here. Again, it's great information, but we'll help you apply it to your scenario as we go here through with some ideas. Standard deductions, of course, went up. The big thing here, though, is I'll stop sharing my screen here, is what the thing that we have an eye on right now. It's a little bit of unknown, but in 2025, at the end of 2025, the tax program we know has the potential to change. It has the potential to revert back to the old ways. We were trying to itemize as much as possible. Remember those days? Trying to get all the itemization we possibly can, all those deductions. Now we have that bigger standard deduction, and it kind of is what it is. Some of you itemize, but a lot of people tend to take the standard deduction because of their scenario. So again, that's the biggest thing we have an eye on for you. Again, we'll talk to you individually about your plan, but there's opportunities and we'll find them for you.
Yeah, Ken, I appreciate that. It looks like the TJCA, that's Tax Cuts and Job Act, is what's reduced taxes for 10 years, will actually revert to the pre-2017 levels, which means 37% will be 39.6. It'll all basically move up. And you will have a SALT, that'd be state and local tax deductions, as well as will be reduced to 10%. That's where all the states like California and others who have huge taxes were up at arms going, you can't do that to us. We live in these expensive states. So there'll be some interesting ones. And that was one of the questions we had from one of our clients too, Ken. So I just wanted to reiterate a couple more things. So
I appreciate that.
Before we move on quickly, Ken, would you mind sharing your screen one more time?
Sure.
Please. Yeah.
I just want to point out to everyone that's on that Ken actually pulled this up directly from our website. So if you want to download a copy of this, you can go right to gentianfinancial.com and you can find a copy of this. You can save to your computer, print off, or if you would like, we are more than happy to mail you a copy of this as well.
Absolutely. Thank you.
Very good, Peter. Thank you for bringing that to our attention. We appreciate it.
All right, taking a look at the next item after we've covered taxes so thoroughly. Any really difficult tax questions, of course, call Ken directly. He'd love to know those. And actually, we'll refer all very difficult questions to our CPAs and our accountants and enrolled agents when it comes to taxes. So thank you all as well. We have a very close connection with them. We'll talk more about another time. But we want to get to rebalancing. This is a very, very big topic. Now, it may seem like something rote to you, may seem like something we talk about all the time. But as we go into the details of why this is extremely important, we tend to just gloss over it in our meetings and say, hey, we're rebalancing now. You go, oh, okay, that's good. But we will sometimes like to delve into it. Zach's going to give us some ideas about rebalancing here, just to kind of enlighten you again or re-enlighten you as to why we do it.
Yeah, thank you, Chris. This is one of mine and Mike's favorite topics. And when I started 6 years ago, I came in with a bunch of different questions for everything that we did. And one of those was, why do we rebalance once every year? And Chris was kind of like, well, find out, make sure that that's the right case, and delved into a huge, massive study over 20 years to see the impacts of rebalancing monthly, quarterly, annually, and see which actually is the best. And it turns out that rebalancing on an annual basis is the best because it allows for different asset classes to run and gives them enough time to run. The most important part of rebalancing is that it reduces risk. Right? It trims back from what did really well, buys what may have not done as well to get back to our original allocation. But if we go back long enough and go through market cycles, it actually adds return as well because you're selling high and buying low. And if we look at one of my favorite charts, to look at the jelly bean chart here, looks like a bunch of different colored jelly beans, may be hard to see, but the idea is that the different colors represent a different asset class on a year-by-year basis, and they almost always flip back and forth between what is doing extremely well and what didn't do as well during the year. And one of the best examples that we had was from 2022 to this last year. A lot of peers in our industry, especially some top teams out there, made pretty substantial bets that certain asset classes were going to do better than others. One of those being large cap value, the Procters and Gambles, the Walmarts, the Johnson and Johnsons, the companies that have been around for a long time. And then large cap growth, they trimmed their positions, added to large cap value. They were temporarily right in 2022. But they thought that trend was going to continue is the exact opposite in 2023. And they didn't also give themselves the chance to buy low during that time. And because of large cap growth being the worst asset class performer in 2022, if we rebalance any time during 2022, we are actually adding to that position. What did the best in 2023? Large cap growth, right? So we saw an immediate example of why we rebalance. And also this year as well, when we were rebalancing, depending on your strategy, we more than likely bought small cap and global real estate in some form. And those were actually the best asset class performers in Q4 of last year as well. So again, rebalancing is one of our favorite timeless principles, and it really covers a lot of different principles, asset allocation, but really there are no future facts. We don't know what's going to be the best performer next year, so we own them all. So with that, let's move on to one of my other favorite topics, which is charitable giving. We've had the opportunity to go through and share with a lot of nonprofits in the area on how they can teach people that support them how to give. And we've also done this over time for you as well. And some of the ways that we can do that are through qualified charitable distributions. Many of you have already started doing this. If you're over the age of 70 and a half, you can give actually directly from your IRA to charity and pay no tax. It used to line up directly with your required minimum distributions, which used to be 70 and a half as well. And now the required minimum distributions from your IRA or pre-tax investments is now 73, but QCD stayed at 70 and a half. So if you're approaching that age, that is a phenomenal opportunity to be able to give to charity, especially if, as Ken talked about, you're not able to itemize and you use the standard deduction for that. One that's becoming more and more popular as the years go by here is a donor advised fund. It's essentially because of the double standard deduction being so high, and more than likely your charitable giving doesn't push you above that unless it's a unique year. You can actually give several years worth of your charitable contributions to a donor advised fund, take deduction in this year, and then disperse it to a qualified 501c3 over time. So it's becoming a very unique tool, especially if you have an event where you have a higher income year than expected and are sitting on a decent amount of cash. And then one of them that we've looked at over time as well is just giving appreciated securities. You want to make sure that they've been long-term, so you've held them for over a year, but instead of selling them, paying tax on the gain, and then potentially not even getting a tax benefit as well for it, depending on standard deduction versus itemizing, you can actually give that stock to a qualified 501c3 and pay no tax on that. A question that we often receive is, well, I really like that stock, I still want to hold it. You can actually buy that back and it increases your basis. So in the future, you potentially have less tax as well. So a very good timeless piece there, and what we really enjoy when it comes to charitable giving as well.
Thank you, Zach. Yeah, there's a lot of ways to give in a charitable basis. I appreciate that. And there's some great ways to do it. I think you guys each have an individualized desire to do so, and we appreciate your sharing those with us. Let's head into another category, which is Roth conversion planning. This is a short one this year, but some of the ideas here, just super quick, Ken will go through in the Roth conversion ideas.
Yeah, Roth conversions. Thank you, Chris. We appreciate that. And why do we talk about Roth conversions? Because they're awesome. For the right scenario, we love them, and we think about why we do Roth conversions. And Roth conversion, just for those who aren't as familiar as some, that Roth conversion is where we take money from your traditional IRAs and basically shift it over to your Roth IRAs. Why do we do that? Because the Roth IRAs don't have any tax, as we know now, don't have any taxes on the gains as they grow. So that becomes a very powerful bucket of money to have now and also in retirement. But we think about why we do these. Are they for you? Sometimes they are. Sometimes they are, because if we do these early enough in retirement, we might be able to tap into the Roths, a little bit later for income planning purposes for you. They're also for family wealth planning and building. If you think about this, if we're paying taxes on some of this money at 12%, yet if there's unused money that maybe the children or grandchildren are going to receive from you, if that's your plan, they might be in a 20 or 24, 20, to 24% bracket at that point in time. So now we're losing 10% just on taxes alone. This is why we talk about Roth conversion. So again, a good family wealth building type of idea that can be very beneficial for you. If you think about this, why do we talk about Roth conversions and market corrections? Because they go hand in hand beautifully. When the markets are correcting and we are temporarily going down, one of the best offensive ways to build our wealth and rebuild it back up when we get that favorable bounce back is a Roth conversion. Think of a pogo stick. Remember those pogo sticks we used to jump on? We jump down on them, the spring compresses, right? And then all of a sudden, when things rebound back, we spring back up. And that's exactly what we do when a market correction happens. We slide the money over when the spring is compressed. And when it bounces back up, then we get all the benefit on that growth, and that recovery is all tax-free at that point in time. So that's why we talk about it with you very much so. Again, we'll talk about if it's right for you, how to fill up these tax brackets we're talking about from the previous slides. Looking forward to our conversations about Roth conversions.
Thank you very much, Ken. So I'm going to hop back to a couple of questions again. One, I've got one of those can't win questions, which just says immigration. So that's a can't win question. So I'm going to actually answer that in a different way. The second question is, I'm concerned about the impact of growing national debt compounded with the financial burden of some of the crisis going on in the national economy, also to do with immigration. But these two things, if we look at the national debt's huge. It's going to grow to 153 trillion at the present potential rate at 2059. Some point, somebody will have to pay that. We've only had 2 presidencies in history that have actually reduced the national debt, actually 3, not increased the national debt, I should say. The economy sometimes will come into great times if we actually look at somebody who might do some financial planning for the government and stop spending so much money. The big worry is what's happening in this. I literally was watching this on last night. There was something called Fact Check on PBS, and there's a couple of women talking about this, and they were very, very well educated. It was an interesting topic because they said the biggest issue could be that we might have to cut some of the programs to give money to people if we can't afford them. It was an interesting comment. Now, how about this? We're going to have to stop spending if we don't have the money. That's a personal finance thing. So I think one of the things that we were looking at before, some of the advice we saw from a great psychiatrist on when you're doing things you shouldn't, there's an answer to that. Stop it. So I think on the national debt, we need to stop overspending. Ken knows what I'm talking about on this as well. It's a great, but you look at this, we just need to have some fiscally responsible, and we need to elect them. There's a bunch of people getting out of politics now because it's become a horrible game, they believe. But we need people who are serious about spending less in a reasonable way, hurting as few people as possible. But there's going to be things we're all going to have to tighten our belts on when it comes to the national budget, because right now they can just continue to spend what they like. Now, that's a lot of opinions I've heard from others. It's not necessarily mine. It's many other people bringing it in. The immigration issue is something completely separate. Coming originally to this country from a migrant status, from Eastern Europe, I have different opinions on this. Offering my opinions is not what this forum is about right now, and offering, but there's all sorts of things to go with it. Fiscally, financially, we have to come into something where people can agree upon what's happening at borders, what's happening with immigration and people coming in, and we need people to work. Our unemployment is low as possible. The way we've historically done that is by having new people come into the country to take jobs we don't want to take. If we prevent that, inflation occurs, and we complain about that. It's kind of a rolling preamble, right? This is where we get into the mix of all this that can become very opinionated. So I don't want to go into that. There's a lot of opinions that go on it. I do say we do need to fix it. We need to come to agreements. No side is probably going to win if you're on a side. But we want everybody to win as possible. Best solution for everyone we can. Now, what I wanted to do as well, there's another topic that comes up quite a bit here. I know I didn't answer that one well, but I try to give it a shot at some different opportunities. But the question that people are asking, and this is very, very common to our clients, what might be the best way to assist grandkids with college funding this year? Personally, I'd say tell them to get a job. No, I'm joking with that. I'm only half joking with that. We've got a lot of clients who have money that they're not going to spend, or they really, one of their goals in life is to help their children and grandchildren get through school. Their children are already growing it out. How might I help my grandchildren? There's a lot of different ways that aren't necessarily going to be a blanket way, but sometimes the Roth IRA is a wonderful way. If you don't know how it's going to work, you're going to find there's a lot of different ways you can help them, staying under the gift tax limit as well. Also, paying the school directly versus giving money to a student is another way. There's a bunch of ways to avoid it, but it's a subject that we'll probably put a module together on, because it does come up often, and we've helped each one of you craft it. And now I'm looking at this going in perspective. It'd probably be great if we put something together where here's some different thoughts about that. You can have it. We can give that out to you at some point in time. And it is one of your strongest desires, helping the young generation educate themselves. What you might want to do is send them to TikTok. I'm just kidding. There's actually education beginning to go on TikTok now as well, in very short spurts that keeps their attention. They will remember it. So just as an FYI, there's different means to doing that as well. But it's a great question, and there's a lot of different ways we work with clients in a creative way. It's not just 529 plans. That's a great one as well. But, this year, May 29th, which is my daughter's birthday. I'm just kidding. She was born on 529. So it's kind of funny. I did have to set up a 529 plan for her just because she was born on that date. We'll talk more about this individually and put a module together. We'll do some work. So thanks for that question. That was an awesome one. Continue feeding questions if you'd like, but I'm going to go to the next category, which is Social Security planning. We had a modest rise last year in Social Security. Does anybody want to tackle Social Security? There's not a ton to go on with it, just the rise in Social Security.
Yeah, I can jump on in, Chris.
Yeah, Chris, it's the rise in the increase that we saw around a little north of 3% it was.
Right.
Really, it comes down to some strategies around this. And again, like this Social Security planning is really, really specific to your scenario about when do we need income, when do we want income.
Yes.
If a spouse has this scenario, if a spouse has that scenario, right? Who is a higher income earner? What about if we lose a Social Security, when we lose a spouse? I know I don't talk about that too much, but it is a very real thing that we work with the surviving spouse on, is to say, okay, if we lose one, which one are we going to jump up to? And are we okay there? Right. So there's like 5 or 6 different facets to Social Security planning, and very individualized, and will very much help you out and identify those strategies to maximize that for you.
Awesome. Thank you, Ken. Let's hop into a very short discussion of income planning. We got 2 topics left, and then I want to hop into explaining what's going to happen for our spring preview, and also where will you live.
Yeah, I can just quick touch on a point for income planning here. We can go many different directions with it. Ken did a phenomenal job talking about Roth conversions and filling up the different tax brackets. That's one asset of it, faction of it. The potential for family tax bracket management as well, is that depending on your goals and your legacy goals is, what are the tax brackets of your children or grandchildren, or if you have the inkling to give to a church or charity of some kind, maybe labeling those assets potentially to be tax efficient. One item I just wanted to highlight is we often talk about tax loss harvesting and Roth conversions to reduce tax as well. One thing that's in our kind of filter of looking at filling up tax brackets is tax gain harvesting, that if you have something in a long-term capital gain status in a non-retirement account, looking and working with you and your accountant to fill up the 12% tax bracket as an example, you'd pay actually 0% on that capital gain potentially. So it would be almost a tax-free sale of that asset. So that's one thing that we continue to look at there as well, capital gain harvesting and income planning.
Thank you. Thank you very much. When it comes to income planning, the nice thing about what we've done with many of you is we've had the chance to look at 3 different buckets. One that's post-tax, pre-tax, and taxable, which is your IRA. And what we can do with those is look at how we can, in a very smart way, produce income. A lot of people don't look at that. It's a very, very high alpha to your retirement. But a lot of people look at it just returns. I tell you what, there's probably over half the value we provide is going to be in structural planning. So this is a massive portion of what it is we do. Make sure that we can talk deeper about it if you like, but I want to bring perspective to that. This is another reason you bring us in, and it's for how we craft that in the let's call it the intricacies you can have with both Social Security, IRMA, and taxes. So anyway, great one, Zach. I appreciate that. Last one, how about healthcare planning? Ken, do you have anything on healthcare planning?
Yeah, healthcare planning is a really big one for the decision to retire. Mm-hmm. And so when we look at this piece, there's different ways. It depends on when we retire, what age we retire, because we may have to bridge a gap. If we retire at 62, We have to bridge the gap between 62 and 65. And we do that with health insurance planning, either through COBRA, either through a spouse who is still working, either through the open marketplace. Basically, that comes down to income planning as well. If we're in the open marketplace, there's subsidies. So there's so much interplay when it comes to income planning, Social Security planning, healthcare planning. Again, a little bit individualized as well. There's also Medicare that we have to make decisions on. Is there an Advantage plan, the supplement plan? There's Medicare Part A through Z, the whole alphabet soup. We have to navigate that piece. So we have great partners in this area that will help you. If you've made a decision and not sure which one is the best for you, talk to us about that. We have great partners that can identify either you made a great decision or, hey, by the way, there might be a better plan out there for you based on how you're utilizing healthcare, what you're utilizing it for, what prescription drugs are we on, what do we need, what can we go to the generic on, what do we need for the name brand one to make sure that it gives us what we need for health-wise. How often are we seeing the doctor? What are we seeing the doctor for? These are all great questions that you guys bring up to us, and we have wonderful partners that can help you out with this very, very important piece to your planning.
Thank you, Ken. I appreciate that as well. And just running over some of those different topics for us, that's the 7 different things we're hearing from you. Some of the other things we hear from you, we'll talk about, we've actually created programs around as well. There is one question here. It's a bit odd. It's about knitting. I guess one of our clients is really big into knitting. And the thing when you're looking at knitting, I had a question I actually asked about this as well. So you've got this knitting club that you're in. Yes, you do. So I've got a question that will go along with that. So when you're knitting, when you guys have a whole group of people out together and you're trying to select what it is you're going to do next, is that called nitpicking? And anyway, yes, it is a dad joke. It is quite funny, I think, but I wanted to offer that one to you. And that was in the question and answer. So I don't know who put that one in. Oh, it could have been me. At any rate, I want to go forward here to the next section. We've got something here that we have called Where Will You Live? This comes directly from you. We have something set aside April 24th and 25th, and we're going to do a little survey here that's going to also be brought up when we talk about our spring preview in the forum. So we'll have a slide that comes up. We'll put this poll up. And I want you to take a moment, if you will, if you're interested in this, in the Where Will I Live, either participating as somebody who can be an informant or somebody who wants to be informed, because we've got it all the way from your parents to you being one of the people looking at where you want to live. And this has been a big, big topic for us. So this is something we've created a module and some thought around. So as we go through to the next one, I want to say, I want to talk about this. We want to put up a poll that has a couple questions. There'll also be one at the survey at the very end of our program today that does the same thing as well. But I really would love you guys to answer that because it's your input that will help derive the program. So we're going to give you a couple of minutes right here, and I'm going to give you a preview of the music from the Spring Forum. It's modeled after both Tony Robbins and Peter Diamandis programs, and it talks about how can we have an uplifting program. So we'll give you a couple of minutes right now, and then I've got a few more things to share with you on what the Spring Forum will look like.
While you're answering this poll, I know I had to do it. This box that pops up for the poll, sometimes you have to bring it to the forefront of your screen if you're looking at it that way. Sometimes it's behind. So if you notice that, there is a box out there that says untitled poll. That's the polling question that we're talking about that you need to find.
And so far, we have 2/3 of you who have not fallen asleep, which is outstanding. It means you've answered the questions already. That's great. We'll give you another maybe 30 seconds or so here. We've gone about a minute. We've got about 25 or 34. And I'll talk about it at the summary here. 27, awesome. There's only 7 left, unless there are clients who are bots there. Well, 28 of 34, that's even better. We're at 82%. So we also had a client who raised their hand. That might have been by accident, so I won't call on you, Sturge. We're at 31 of 34. That's awesome now. So 31 of 4, it's 91% participated here. And looking at the three options we've got, Gentian is going to be hosting a Where Will You Live as We Age in Retirement in-person workshop this spring. What would you like to hear about? And in this case here, out of the 31 of 33 that we have, it's overwhelming 21 out of 31. Aging in place. I'd like to stay in my home as long as I possibly can, and I need resources for people that can come to my home. It's number one. Number two is senior living communities, active adult communities, and retirement villages. I'd like to take a tour of the local facilities within the 25 miles of the area here. So that's about 30%. And then continuing care residential communities. I have a place in mind that offers a range of care options with the same location. So that was, in this case, 13%. Thank you. So the majority obviously would like to stay at home as long as possible. That goes without saying. I'd say the following categories will go beyond that. So Peter can share the results from that if you'd like to. He did, sorry, with those. But what's really interesting about these things as well, I have found one of the most important things as we go forward is community. Family and community and the relationships actually lead to happiness and satisfaction in life. It's not the money. It's not even where you live, but it's who you live by, who you communicate with, how often you might see them. So don't reduce that as well. If I'm going to stay at home and I'm around other people that I like, that's fantastic. But the isolation sometimes, especially with my grandfather at 88, when his wife, my grandmother, passed away, at 87, she passed away, and he was living by himself. He had a cold that attacked his health a little bit, and he just became depressed. He wasn't around people. He'd cook for himself. He didn't want to do all the things he used to do. And what he found is we moved him to a place where there was 40 different residents in this continuing care residential community, a nice little apartment. But the beautiful thing is the people around there became the community. He not only, we didn't think he'd be there for more than 3 or 4 months. Not only did he recover, he thrived for almost another decade. We got to spend 10 more years with my grandfather, the patriarch of my family, by him, and there's no doubt he would say it as well, by him getting into the community. He was a Valentine's king several times, the prom king several times. It was hilarious to see them, but it was something they could do every single day, and it gave them purpose again, which I think he would say was a big part of that overall experience. So in whatever situation we want to be in, obviously we do, but if we can't, what's next? That's what we're going to explore too for you. Let's make the decision while we still can and while we've got the agency to do so, rather than when it has to be made for us. So that's part of what we're doing. This module really comes from you and the questions that you have. With this, I want to go back to the next, back to the presentation. There's 2 more slides here, and I want to give you this. This slide right here, I created with the help of chat.gpt. I said I wanted a dystopian human connected in a future society, and I gave it some of the ramifications here, and it created this, which we're going to print and hang on our wall. It's the future of a connected human in an AI environment at some point in the dystopian future. Now, what you'll find is DALL-E or chat.gpt or any one of these artificial intelligences are out there. We're going to talk quite a bit at this about artificial intelligence at the Spring Forum. And what you're going to find is it is pervading almost everything. Let me give you one example of it. So this is DALL-E, D-A-L-L-E. It's one of the chat.gpt items. Chat.gpt announced today they want to democratize artificial intelligence. Democratize, meaning that it's inexpensive and it's chosen by everyone, and it's not something that has a big barrier to entry. And that's an awesome thing. It's something that Google's tried to do with their operating system and like their Google Drive and Maps and things. Also the same thing Elon Musk is trying to do with his cars and car patents. He's not just holding them. He's saying, here, use them. If it's good for society, use them. Taking a look at how artificial intelligence pervades almost everything, I think it's Google put together a Google Assistant. My Google Assistant every day can come in and give me different ideas. Like, for instance, I have it tell me a joke every day. So what do you call a cold canine? A chili dog. So you can blame it for giving me some of these, but I've got a whole process. Is there any news? What's the weather to this? And you can set it at different times. You can set routines for it to actually help you on a consistent day-to-day basis. So we're starting to find things that are called like Jarvis. If you watch the Marvel movies, Jarvis is something that goes out and helps you, learns from you, knows your preferences, finds the things you want. It can actually do them for you without you even have to spend the time to do it. There are things that are going to be, if you'd like to, you can take advantage like that. There are also those who want nothing to do with it. I like to be in a garden and not have any help with that. And not have any technology connected to me as well. There's going to be 2 different types of or people in society, if you will, or probably 100 different people, but along a spectrum of very well connected to wanting to be very disconnected. And I think that there's some validity to all of it. There's a book by Jerry Mander called In the Absence of the Sacred, written in the 80s and 70s, about what technology and what television, what tubes and being connected is doing to society. Really interesting ideas. But today it's almost unavoidable to run into artificial intelligence in some form. And it's literally weaving its way through everything. It is potentially the next platform, and most likely is the next platform, to move the economy up in a higher level as far as productivity as well. Just like the internet did, just like computers did when all accounting used to be manual. It's another technology that could dramatically make us more efficient with the time that we decide to spend working. So reassigning humans to humans. One of the biggest parts of artificial intelligence I am finding personally is the conversation that goes around. If artificial intelligence is going to take over some of the rote tasks, if you will, what is it that we can do with our time? We can become better humans in some form. I tell you what has lacked over the last, probably since COVID, is human communication, going out, reaching out to other people, spending your time with people in community, being kind to others. And I don't mean that for everybody, but I think in general, if you go to an airport, most people would agree with me in that same statement. Most people are kind of out for themselves again. So I think we need to kind of revamp that back to, hey, listen, let's teach gratitude. Let's teach all sorts of things back to each other. Let's practice gratitude. So I want to go through some of those items that we'll be talking about, but artificial intelligence is simply going to be a tool that you can use. You can't invest in artificial intelligence, but it is a modem. It is a model with which we can use, just like the internet and others, toward higher productivity in certain areas, if you choose to use it. You have anybody who has a cell phone, but instead of this, they have the flip phone because they don't want the stuff that's on here, right? It's the same kind of thing happening with AI. You can choose to use it or not, but it's going to be in most every product you'll have. So understanding it in some form is probably reasonably acceptable. If you want to throw up, Peter, up the last chat.gpt slide, I can kind of show you that one. Thanks, sir. Yep. So chat.gpt, just giving you an idea of the different. Step 1 is collection and demonstration data and train a supervised policy. Step 2 is collecting comparison data and train a reward model. Step 3 is optimize a policy against a reward model. So this essentially is showing you inside chat.gpt how it's working. What I want to do though is I asked chat.gpt a question, which was kind of interesting here. I asked it on national debt. I asked it on several things. But I said, well, what about savings? I think one of the biggest ones I asked it here, which is kind of fun, is people fears. Hold on a second here. So I asked chat.gpt itself, and it takes a ton of data. It'll go out to the web and find this. So what can I say about developments in artificial intelligence? So this is what it said about itself. Number 1, machine learning and deep learning. Machine learning and deep learning has been significant in its progress in the last year or two, enabling machines to process and learn from vast amounts of data. And this has led to breakthroughs in image and speech recognition, natural language processing, predictive analytics, and things like running experiments when it comes to pharmaceuticals, autonomous system from self-driving cars to drones, AI in healthcare. AI applications in healthcare are revolutionizing diagnostics, patient care, treatment plans, and also treating the disease, not just with a drug and the symptoms. Natural language processing is massive. In natural language processing, you can now talk to your AI. I can talk to chat.gpt and ask it to read back to me or talk to me rather than it having to read it on a screen. So it's now interactive. So you've got a lot of chat bots. You can now have a person in front of you asking it questions and they'll respond with the chat.gpt data. AI ethics and bias mitigation, that's a huge one. Who put the language together because their bias is in that language, right? AI and environmental and climate change. Some of the ways we might be able to help the Earth is actually by asking chat.gpt to run massive models on how we can most affect climate change, or can we at all, right? Because some of this has occurred beyond human. Quantum computing in AI is massive. We'll talk more about that another time. AI in creativity and design. It often can give you the basics or an outline for a paper, but you have to write it yourself, especially if you're a college kid, because there's software out there to recognize AI-driven responses. And if 10 kids use chat.gpt in a class for the same topic, it will provide a very similar, if not the same, paper for kids. So they can teachers can find that out fairly easily as well. Also, when it comes for AI for social good, They say organizations and research are leveraging AI to address social changes from hunger and poverty to improving access to education. And then Edge AI. This is the rise of IoT devices. This is having something like the Whoop on your wrist, a ring on your hand, and providing it when you get home after all that you've done, it can actually calculate what it is you might need for a meal to replace what you've done today for the activity you've processed, and may suggest what the healthy options are. You also tell it, listen, I'm allergic to nuts. Great. It's going to give you a non-allergenic idea. So this is some of the things that Chat.GPT told me to tell you about itself, about artificial intelligence and what it's improving, what's going on with it. We'll talk a lot more about this, as I will have been to Abundance 360. We'll talk with the people creating it. Last year, it was all the buzz, but nobody quite knew what the heck it was doing. When we brought it up to you 7 years ago, it was a very, interesting. Now it's in our lives and it's pervasive. So our goal is still to continue to provide you with things you can do with it, so it doesn't do something to you. You can make choices and have agency. You can make choices about it rather than it doing things to you or it sneaking up on you. So with that, there's a lot that can go with it. I get very excited about it, but I want to close today with a couple of different things. I want to thank you tremendously for your introductions. Our team has been recognized in a magazine now as one of the top teams in America. That's due to you. Obviously, it's the people in here as well. They're phenomenal. We really are very blessed to have the people we have. I'm lucky every single day, but not just for the anniversaries, but to have the people here that we have contributing to my life, to your lives, and really helping me grow as an individual and a person. I started this practice. It was me. It was me and maybe a partner at the time, but also maybe we added Lisa, we added Ashley, right? We added a few here and there, but I realized, there's some great things that these people do, and we need more of that. So as we did, we continued to add more and more teammates, almost like the Brady Bunch box you saw earlier, where there's the 14 of us. It's really impressive that these people have chosen this journey, this path with myself, with you, and together. And together, they're absolutely amazing. So I want to thank them tremendously for their dedication to your experience. I also want to thank you for introducing us to people that you like and that are kind, and that we continue to grow this practice. It's something that we've committed 100% of our time to working with you. And when you find somebody and you introduce them to us, that is absolutely fantastic. We appreciate that. And it helps our group continue to grow and serve more. What we also looked at here as well, I talked about family and connections. We're looking towards 2024 and 25 to create opportunities for you to experience things and enjoy things with people you love. They may not be clients. So we might have a friend. You might have somebody you want to bring along. You want to have them. We're looking at more and more ways to include in our existing events. Bring a friend. And not a friend that we're going to prospect, just a friend to come by because it's some great information. You want to hear it. You want to spend time with them. So being inclusive of that as well is a big part of what we want to do, because that's your community, that's your tribe, that's your family. We want to make sure they're all taken care of and get the best information that they possibly can as well. And with that, for just being you, thank you for sharing what you have. Thank you for sharing who you are, and most importantly, your time. These programs that we try to put on, we try to pack a lot of data in a short time. Some of it may be repeatable. And we've repeated it before, but a lot of it's the basics we need to also go over on a consistent basis. But your time, we know, is super valuable. With which you're probably saying, Chris, can you just stop talking now? And the answer is I will very shortly. We're trying to make things more interactive and make these programs for you more and more value. So always please share ways that we can. There's going to be a survey at the end that will tell you that. Also, when we're in our meetings, tell us how we can make this more valuable. We are always getting better here. That's one of our goals, is to AGP always try to get better. And with that, I want to make sure that you're a very, very strong part of it. And you're the why of that. So with that, I want to make sure we give you our gracious thank you, our gratitude for you working with us, for your trusting with us, for your sharing with us, and for making this team recognized as one of the top teams in America. We are blessed for that. We're blessed by you. So I say, from our galactic headquarters here in Mequon, Wisconsin, I want to thank you all. And if anybody wants to come back on and wave at the end of the program, Peter, that's up to you. I'm going to say thank you from all of us here. Thank you for your kind attention. We look forward to seeing you. With that, I'm going to say, anybody who wants to wave, who's prepared to wave, let's welcome all these wonderful clients. And they're all waving back. I can see it. They're not on their couch. They're waving back. I can see there, Kathy. I see the hands going up. Thank you. With that, thank you tremendously for today. Hopefully it was a good fall forum. For those of you watching this afterward, enjoy. Hope you're wonderfully enjoying it as well, I should say. But we appreciate you as well and what you bring to us, even watching it after the live program. With that, have a great rest of your Wednesday. Here's the QR code as well. Please take a photo of that. take your little camera on your phone. You have it right there, and you can do that, and you can answer the questions right from it. Actually, what I should have told you is there's a massive surprise with the QR code at the end. And then you maybe would click on it and take a picture. Anyway, with that, thank you very much again.